What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, the biggest earnings week of the season is officially over. All of your mega cap companies have reported. Markets insanely volatile. In this video, I want to go over a few things, what to look for when it comes to getting into the month of May. Generally, April is very generous to the stock market. Wasn't so much for us this month. But we're getting to another critical level while a lot of things behind the scenes are changing. So in this video, I want to give you a good overview of what is happening, not only on the forefront, what we're seeing on the actual price action, but what is actually moving the markets, and it might surprise you. So let's get right into it. First off, as you can see, two companies yesterday really pulling down the entire market. Amazon came out and it led their worst month since 2008. It was one of their first quarters, I think, in 20 years. They have not actually grown. A big issue with Amazon earnings was the acquisition of Rivian EV maker, really pulling them down. I think it was a $7.6 billion loss, but they are also facing supply chain issues. And they did mention a little bit of weak revenue and guidance going forward. However, consumer spending hasn't really started to slow down, but I believe they're starting to see the peak of it hit, and we're just getting to that downturn. So their guidance going forward was not good. Now, in the contrary, Apple had reported monster earnings. I mean, this was a great report across the entire board, and the market reflected that after hours. And you can go through a couple things here, and I'm going to highlight one difference at the end. They announced a 5% increase in their quarterly dividend, a $90 billion buyback. The stock buyback program is going to be happening despite of all the issues that were going on in China. And they also had issues last quarter. They reported saying iPhone sales were starting to slow down. I mean, there's only so many times you can come out with a new version that basically has an extra camera or an extra feature to where it's just not really enticing for individuals to keep on buying. But they stated this on the call, and this was the big hit. All right, the company expects a $4 billion to $8 billion impact on June quarter revenue from supply constraints. They're still feeling the effect of that, as well as some COVID-related shutdowns going forward, because they always like to look forward. All right, but so the entire market pulled back. I was slightly optimistic in the short term, and you can see here we did have a little bit of bullish divergence. Divergence occurs when the stock price is making a lower low, but the RSI is making a higher high. As you can see, this is a down right here, but the RSI is going up. That is a bullish divergence, and the market reacted well, bouncing off that 413, 414 area all the way up to 430 until the earnings report happening. We are sitting at another very crucial level. Let me zoom out for you. All right, I'll even jump over to the daily chart here. This area of the SPY between that 410 to 420 has been soaked up consistently for this entire year. And it's going to come to a point where eventually, if there's not going to get enough bullish momentum moving forward, the bears are going to take over, and then we're really going to see some good downside. If you look at the weekly chart, it definitely gives you a much clearer picture. And you can see right around here, this 417, 418 on the close of the weekly, which we're floating at right now. There's still a few hours left to this Friday playing out like a typical one over the past like 10 weeks, just a slow fade into the close. But they're really trying to fight for that. Once we break through that, things are going to get a little bit uglier down to that 400 psychological level. And then you got some support in the 390 to 385 areas. But here's where things are getting very, very skeptical when it comes to the short side. How much can these bears continue to keep pushing? So one thing I look at is what is being priced in right now when it comes to the Fed fund rate. We've talked about that numerous times. All right, that everything was slowly, steadily moving. SPY was around 450 when Jerome Powell was speaking at the global economy, and he stated that they're going to look at the 50 basis point hike, all right, and maybe accelerating a little bit quicker, trying to get a big punch off the rip to get rates up there to try to combat inflation moving forward. But I think the markets are actually pricing this in a little bit too much, and any little bit of pullback, we're going to see back testing some of those all-time highs. Now, until you show that trend has really changed. And this weekly chart pictures it beautifully. This is still just a bit of a pullback. The SPY has not really hit that full-blown bear market territory where we're panicking and you're seeing these gaps on the weekly charts like you did back when COVID hit. All right, you have to kind of stay with the trend. All right, and now we've changed. I've adjusted my long-term portfolios all the way since August of last year when they started doing this, and we continue to play the intraday. But for my long-term optimism, my 12-month optimism is still on the bullish side. And here's the reason why. So first off, they've completely factored in a 50 basis point hike for May. All right. And a couple of Fed presidents had stated that a 75 basis point hike, which Jerome Powell did not say, okay, but some other ones did, but a 75 basis point hike would just completely shatter and shake the economy, especially in the short term. However, if you look over here at the June 15th, we're sitting between 75 and 100. Look over here at June 15th, they have completely priced in a 75 basis point hike and are actually started to price in a full percentage point hike in June. Okay, and if you go out to July, it's another 50. So we've got a 50 in May, a 75 fully in June, and another 50 in July. All right, but here's where things change. And I've talked about this. UBS has predicted, okay, and expects inflation to be at a peak. Now, I understand there's a little bit of, controversy saying, wait a minute, inflation should really be much higher than 8.5%. And trust me, I go to the grocery store, I see it. All right. However, you're slowly have seen, especially in the gas prices, we're not sharply rising anymore. We're getting to a point where we're starting to base, and that might just be for the short term. All right, that might be that like the producer price index hasn't caught up to it yet. But if UBS estimates are correct, we'll get the 50 basis point hike in May as expected, but June 15th is the next meeting. And before that, we have two, CPIs that are going to be released. You have the April, which will be on May 11th, and the May, which will be on June 10th. And if UBS predicts this properly, we'll be sitting at 7.2%. It would be absolutely astonishing to see that inflation has pulled back, but the Fed is going to go ahead and say, listen, we just did a 50, double what we said of original 25, okay? We just did a 50, now let's hit on a 75. In my opinion, what is the need for it? You've already seen the tapering begin. We've seen two consecutive decreases, okay, from that high of 8.5%. There's no need for it. Maybe getting another 50, all right, maybe doing those two 50s, all right, in May and June, no problem, then kind of slow it back. But going up to the 75, I think is just completely out of control. Like I said, all of that can change if these numbers come out at 9.5%, 10%, and so forth. All of this can change. But where the market and the outlook stands as of right now, they're overpricing this just a little bit too much. And a lot of the Fed outlook had stated that they're targeting anywhere between, let's say 2.25 to 2.75 by year end. And if you go over here to July, we're already going to be at, 2.25 if this stays. It just doesn't really make sense to me. I think the market is overreacting just a little bit. There are obviously a lot of other factors, but as of what we know right now, okay? And lastly, as you can see here, Powell's seen slowing rate hikes after May and June front load, okay? So like I said, that is the first thing. The next thing I want to talk about, price earning ratios. So things got completely out of control, all right, in 2020, especially early 2021. When you look at Neo and Skills and just a couple other stocks that were just nonstop runners that had insane price earning ratios. The average for the S&P 500, it goes between 13 and 15. We are still a little bit on the higher side. However, the average goes back, over 100 years. And because we are now in this technological, era, and obviously all these high tech companies, okay, are evaluated off of future revenue, I can see that 13, 15, ratio changing to about 16 to 18, 16 to 19 on an average. Well, you can see here, all right, where we were sitting close to around, let's say around that 35, all right, to 40 price earnings ratio. We're all the way at 21. Some of these companies are really, really getting to good value. And I'm not talking about these high growth companies that are just at their all-time lows or trading at their 3 years lows. I'm talking about good, solid quality companies that price earning ratios have come down a little bit. that things are starting to stabilize just a bit. Okay, so just keep that in mind going forward. If you did, take any of, my opinion going forward, what I said last year of slowly dollar cost averaging, we're at another good time to continue to do that. I haven't really built up my long-term portfolio as of yet. I'm continuing, to play the intraday. It is working out very well, except for Wednesday. Had a horrible day on Wednesday. Told everybody exactly what I did wrong inside the group. But like I said, it's going to be interesting, and look for it to hang around this level. And over the next 2 months, we're going to get a good insight of what is expected to happen over the next 6 to 12 months. Now, when we talk about recession, okay, I have, just two thoughts, really quick thoughts on that. One, recessions don't really happen when the entire country is preparing for it. That's my first thought on that. Secondly, I do believe if we getting out of the hole that we dug ourselves into, and especially because of the way crude oil had spiked over 100%, and it's 19 for 19. Okay, now this is the 20th time that a recession has occurred after a spike of 100% or more in a 12-month period. Sure, getting out of this without a recession, no problem. However, I can see that, but we're talking 2020, 2023, 2024, late 2023, 2024, before we really start to see some of the effects, because like I said, we're still at that earlier stages. So guys, that is it for this video. I hope you enjoy your weekend. I'll see you in the next one.